Rates may be coming down, but the cost of a mortgage could be increasing dependent upon who you are. Hey, this is Rich Hayden with Hayden Home Mortgage, and I want to share with you a little bit of information that it's not necessarily new. This news came out on the 19th of January, so we're a couple weeks beyond it, but it's just now starting to take hold in the marketplace. And what it is you may have, your loan officer may have told you about what's something called loan level pricing adjustments. And what on earth is that? And why does the mortgage industry create so many roadblocks to make all this stuff understandable? And what a loan level pricing adjustment is ultimately is it's a way that a lender simply assigns risks and risk assessment to the characteristics of a loan, and then says, hey, somebody's got a credit score of 680, they have a propensity to default at a certain rate. Okay, so it's data analytics. Or if somebody has a certain down payment, a lower down payment might be something that is more risky, but a bigger down payment is less risky for the lender. So what these LLPAs do is they give a lender a chance, and ultimately, when I say lender, I'm really talking about Fannie Mae and Freddie Mac, or FHA and sometimes VA. But it gives them a chance to say, hey, here's how this loan is going to perform over time, and therefore, here's the interest rate we're going to give you for that loan based on all your characteristics. Now, there's something afoot at the Circle K, and what do I mean by that? Well, the Federal Housing Finance Administration, FIFA, has a mandate also to try to expand home ownership, to make home ownership more affordable and more attainable for more Americans. And on the surface, that is a very, it's a very noble cause. And I think everybody would agree that, expanding the opportunity for home ownership is a good thing. But in order to do that, some of these LLPAs need to be addressed. And so let me get myself out of the way. And what we're seeing is that there's actually now going to be, let me try to increase this, what we're calling a new heat map. Okay, so when you go to your loan officer and you talk to him or her, they say, well, okay, we'll talk about interest rates and we'll figure out what the impact is for you. And you might say, well, I went to LendingTree or Bankrate or Credit Karma, and I got an interest rate and it was, 6%. Well, okay, that might be true, but there's a whole lot that goes into figuring out that 6%. What's your credit score? What's your debt to income ratio? What is your loan to value ratio? So there's this new heat map that has come out that says these are going to be the impacts that are going to be in place for different people. And you see where it's the most red, that's where the biggest negative impact is. So somebody with a 720 to a 739 credit score, and if they're putting down less than 20%, they're going to get whacked for 3/4 of a point in terms of expense. Okay, debt to income ratio is going to have an impact. How many properties do you have? Is it a 2 to 4 unit property? Is there, are there a variety of other things? Big increases in fees for cash out loans, all kinds of things. I'll put a link to this article in the description of this video. Definitely hit me up. If you got questions, you can always reach me here at 703-957-0790. I'm always happy to have a chat. You can text me at that number as well. Again, Rich Hayden with Hayden Home Mortgage. I hope all is well. I'll talk to you all soon. Bye.